Welcome to the Nichols Tax Update Podcast, issue 2110 for March 8th, 2021. This program is produced to provide current information about developments in United States tax law, cases, rulings, IRS pronouncements, and expert comments on hot topics. You are receiving it as a member benefit from the South Carolina Association of CPAs. My commentary is necessarily brief, and you should consult appropriate authority before taking a position on any item discussed in the program. I always acknowledge the value of my subscription to Tax Notes Today, a publication from tax analysts, the preeminent source of information for tax professionals. I could not prepare this program without it, and I freely acknowledge the value of what I get from Tax Notes Today. Speaking of what we get, what did we get this week? Well, we get information on the employee retention credit. There are lots of questions about that, and I actually have a source for answers. Then let's don't get lost something that's really old, reporting cash transactions on Form 8300. The IRS calls that to our attention because they're emphasizing a compliance program. Can you really buy insurance for tax positions? Yes, you can. If the tax position is big enough in terms of dollars, there are big insurance companies that are willing to write the policy. We'll talk about that. And then if you had a question about when do you have to check that box, disclosing a client's cryptocurrency transactions, I believe that I have answers for you. And finally, this week, a reminder: charitable contribution rules require at least substantial compliance, but strict compliance is even better, and you will lose the deduction if you don't comply with the rules exactly. So we'll talk about that in more detail when we get there. Let's start with item number one, the employee retention credit. Notice 2021-20, Section 3. This guidance provides guidance in a question and answer format, 70 questions and answers with a lot of examples on the following topics. What employers are eligible for the employee retention credit? When can employers aggregate for eligibility? What are governmental orders with respect to this program? And what is defined as full or partial suspension of trade or business operations? What is a significant decline in gross receipts? There are examples and definition. What is the maximum amount of an employer's employee retention credit? What wages qualify for the credit? What allocable qualified health plan expenses can count as part of qualified wages? How does this program interact with the Paycheck Protection Program, loans, and forgiveness of those loans? And then, how do I claim the employee retention credit? What special issues are there for employees with regard to their income and deduction if their wages are subject to this credit? And what special issues are there for employers who claim the credit? Is the employer required to reduce his deduction for wages? And the answer to that one is yes, as you might imagine. Penultimately, special issues for employers who use third-party payers. 3 questions and answers on that topic alone. And finally, substantiation requirements. But the information is all there. 70 questions and answers. Detail someone in the firm to become familiar with that Notice 2020 or 2021-20 and become the firm expert on the employee retention credit. You'll be glad you did. Next, an old topic, but brought to your attention again because the IRS is thumping the tub about doing examinations for all cash transactions. First of all, you want to have the August 2014 revision. Part 1 is the identity of the individual from whom the cash was received. Part 2 is the person on whose behalf the cash was received. Part 3 is a description of the transaction. Part 4, 3 pages of instructions go on to provide a lot of information, and this form has a separate jurat. This form is required to be signed under penalties of perjury. You need to make sure that your client understands the reporting requirements. Now, there's a catch here. You cannot tell the customer that you need information in order to file the Form 8300. That's the same as inviting the customer into some sort of a conspiracy. So company policy simply has to be that in connection with cash transactions, we require this information, and you probably ought to have a fairly low trigger. So your trigger is lower than the trigger for the Form 8300, which is payments over $10,000 in a single transaction or a series of related transactions. Don't forget that. That has caught some people unawares as well. Next, on the subject of insurance for tax positions. Are you kidding me? No, I'm not. It's been around since 2014. It's available. Here's what Aon says about it. You protect against unexpected tax liabilities and bring certainty to deal and business outcomes. Tax insurance is designed, and Aon was the original writer. Since then, other companies have come into the field, but insurance for tax positions is only 6 years old. It's a relatively new product. And tax insurance is designed to protect you if an investment or tax position fails to qualify for its intended tax treatment. So you put money in a tax shelter. The shelter promoter has bought tax insurance. Oh, by the way, that insurance premium is not deductible. We had an item on that a couple of weeks ago, right? So the insurance can cover losses, including the taxes you have to pay, interest, penalties, and gross-up amounts for tax due on insurance proceeds. It can also cover contest costs tied to the defense of the insured position. Since 2013, Aon's U.S. tax practice has placed hundreds of policies representing over $13 billion in tax position risk. They have 6 full-time tax lawyers who do nothing but vet the applications for tax insurance. How does it work? For goodness sake. So here's the explanation. Similar in effect to a private letter ruling, tax insurance brings certainty to taxpayers regarding the treatment of their U.S. federal, state, local, and foreign tax positions. It's an effective and economic means of protecting against an unexpected or significant impact on financial statements and earnings. So public companies are going to be really interested in insuring their return positions following a merger or some sort of an investment in a speculative undertaking or an accounting position. Fortune 500 companies and other participants in global merger and acquisition markets and financial transactions are the customers. What can you get? You get certainty. You allocate the economic risk of a tax loss to the premium. You know what the cost of the premium is, and you can factor that into the deal. You may not want to have the unknown cost of a tax audit and a deficiency. You avoid or reverse the financial statement impact of your FIN 48 reserves. You mitigate counterparty credit risks. You address the small probability of a significant loss. And you can replace or reduce escrow required by a seller to protect against tax, or required by a seller to protect against unexpected tax liabilities. And you can add to the survival of the seller's escrow. So if the deal is big enough, then insurance for tax positions makes a lot of sense. Reporting cryptocurrency transactions. You don't have to report it if all your client did was buy cryptocurrency. That's question and answer number 5, issued 3/2/2021. If your only transactions involving virtual currency during 2020 were purchases of virtual currency with real currency, you are not required to answer yes to the Form 1040 question. That may be the most important item for many of you in this week's podcast. Then we have 2 taxpayers. I picked them up. They came on the same day. Dwayne Pancratz lost over $2 million in charitable contributions because he did not attach appraisals to his return. You attach the Form 8283 for the contribution of tangible property, and you attach an appraisal if the amount is more than $5,000. Even if it's under $5,000, if it's over 500, you got to attach the Form 8283, and you got to disclose the donee, and you got to describe the property. If you're going to claim charitable contribution deductions, you really need to attach a Form 8283 if the contribution is a property. Now, here's a lawyer, Luke Joseph Chiarelli, who inherited tangible personal property from his mother's estate. That's what the tombstone is for. He had an auctioneer come in to appraise it, and the auctioneer says, hey, look, Attorney Chiarelli, you can get more benefit from this by claiming a charitable contribution for it than you can get at auction. I'll write you up some valuations, and you contribute this to Goodwill or the Salvation Army or whatever. And so that's what they did. The only problem and where this thing failed was Attorney Chiarelli shortcut. He attached the Form 8283, but he failed to follow the instructions. The instructions are specific. You write down the name of the donee. You attach appraisals for individual amounts that exceed $5,000. For 1 year, he entered a single amount, $89,110 for miscellaneous household items. And he claimed that he had a basis in that property by purchase of $251,800. The $251,000 number wasn't true, and the $89,000 number was inappropriate because it needed to be broken up into its component parts. He lost over $200,000 in charitable contribution deductions that he might have got if he had simply followed the instructions for the Form 8283. So it's tax filing season. Follow the instructions. Your client wants to claim significant charitable contribution deductions for tangible personal property. Include a Form 8283 and follow the instructions. That's it for this week, gang. Pretty sure that until next time, please stay safe. We need all of us.